This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GoldenTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GoldenTLong.com, and I have with me this morning Andrew Joseph, who is no stranger to our Trigger webzine subscribers and our now 4 times a week technical market alert updates. Andrew is the principal of GoldenPhi, publisher of Trigger's Media Publications, Inc., and editor of the Trigger's webzine and website. Good morning, Andrew, and welcome back to Macro Analytics.
Good morning, Gordon. Thanks again for having me. It's great to be here.
We haven't talked in a while in terms of what's going on with triggers and in the markets, and I know a lot of our regular listeners would like to get a sense, especially with the markets being so volatile and some of the changes that we've seen recently. I asked Andrew just to bring his most current charts, the ones that he's working on here literally all night, each night during the week, 4 times a week. Andrew, I have up, so let's just jump right in. I have up some additions you've added recently explaining the charts before we get into the charts, to help some of our listeners with what they're going to see here. Could you take us through that?
Yes, thank you, Gordon. Today I brought some charts for the S&P and for the gold, but these are all from our new weekly updates that we have. We've had some new additions to them. So this is one of those, and it's just a page explaining the charts and what's going on, what we're doing with the analysis. It's a good idea to start with this because we're going to be looking at some charts. So if people can familiarize themselves now quickly, it'll help them out as we go through the charts as we move forward. Probably the most important thing that we would want to focus on today. There's a lot of things going on in the chart. They seem busy, especially if somebody hasn't seen our charts yet, and this is the first time looking at them. But number 7, where it says arrows, is what we really want to look at. These are one of the key and most important things that's going on with this chart. And what that's telling us is the base of the arrow is sitting at a significant technical support, trend line, channel, whatever it may be, some kind of significant technical. And that's our trigger. And if the market crosses that trigger, the arrow points to the next significant level, trigger or resistance, technical level that the market's going to move to. And we're pretty right on with that, with getting these levels that when a trigger line is crossed, the market very frequently does move to the next technical level. Our high probability targets, which you can see those green boxes, are the next thing to look for. How we get to those boxes is through the technicals, and the arrows show where we're going to have likely to be significant resistances, supports. And these areas are probably going to be consolidations. And if we have it wrong, those areas will have a reversal and it won't get to our high probability target zones. That occasionally happens. But we're sitting out at over 80% accuracy with the high probability target. So, anyways, this is how you read the charts. And so as we move forward, what you want to look at is the arrows that we're talking about in the high probability target zones.
The essence here, we're not trying to identify the actual trigger or necessarily the direction. More that when in fact it's triggered, the probability is it's going to go to what is labeled the HPTZ, the high probability trading zone. That's where your accuracy is and where the technicals really tell it. To know when the triggers has happened, you can tell it from the boxes often, or a bias. And we put in some mechanics here for drivers and triggers, which identifies what we think the bias may be. But you may have you do your own research on that. But once you hit a trigger, the high probability trading zone, typically from a technical analysis, is what we hit. And you have all the statistics on that, right, Andrew?
Yeah, we're looking at this in almost doing over a year now.
And then they're on your site, and they show exactly the kind of statistics. It says that the technical methodology that you're using works, but exclusively to identifying the high probability trading zones.
The point is to have this as a purely technical system as the backbone for anybody who wants to do trading, regardless of their time frame. They can use this for very short time frames or long time frames, pivot trading, swing trading, or high frequency day trading. the point is to use technicals, and the technicals act as your triggers. And by doing this, you eliminate all bias and what you think. I mean, it's always nice to have a bias in what you think is going to happen. But ultimately, what you want to do is trade the triggers and follow along what the market's going to do, not what you think it might or might not do.
Yeah, you can get a lot of troubles that way because the market will fool you. It's designed, not designed, but it always does that.
Exactly.
It fools the greatest number of people the most often. Let's talk one right through. I have the S&P up from your Tuesday morning chart.
Yes, this is the cover page for our Plan 2, and the Plan 2 comes with website access and the inter-issue updates. The point of the inter-issue updates is that we have a monthly analysis in our monthly publication, but once a month really doesn't allow you to stay on top of the market. So with our Plan 2, we have 2 times weekly update on the S&P 500. It does a weekly, a daily, and an hourly update for those. This is the front page for Plan 2, and you can see a couple of the new additions that are highlighted there in yellow, and that's the macro drivers and the macro triggers. We just took a brief look at the understanding the analysis, which is the other new thing. I wondered if maybe you want to talk a little bit to the macro drivers and macro triggers, Gordon, because I know these come from you, actually.
Yeah, we spend at Gordon T. Long a tremendous amount of time looking at the macroeconomics, and from there we draw some pretty good conclusions of what we think is going to unfold, when it's going to unfold, geopolitically, et cetera. And we try and then relate those into 2 elements. One, what we think will be the driver of a particular market. In this one, we're talking about the equity markets and specifically the S&P, what it'll be and what may be a triggering event based on that. That's not looking at the technical charts, though we study them quite a bit also at our end, but that's looking at it from a macroeconomic standpoint. So, for example, here in the drivers, that we really see in our study from a fundamental, an earnings shock problem that's coming here in Q2 earnings when we get into the actual earnings guidance, because we have problems of significant proportions with margins that are going on right now, which are disguising. Earnings have been steadily brought down, but the equity risk premium has been hiding some of this, and it'll start to come out, we believe, over the next 2 to 3 weeks. To what degree? Don't know, but there's a bias that's built in because this is the reality of it. This is not speculation. We know the actual numbers in that regard, and we publish all of that separate from the technical analysis. The triggers, we're kind of looking at it and saying, well, therefore, these conference calls are critically important. You've got the July 19th option expiration, which is always critical of the renewal of the derivatives and options pricing. You've got a full moon, which for whatever reason seems to drive markets. And we've got a cluster set on July the 22nd, or rather the full moon on the 22nd, and a cluster set of FIs on the 26th. So there's a lot of tie together at that particular point in the month that needs to be watched from a triggering standpoint and based on those drivers. Now, that's what you're watching. It says if something starts to unfold, your charts are going to show where it'll go, either up or down. I have up the weekly chart.
Yes, and this is current as of July 16th. This is what they got in the morning. And the weekly is giving us a long-term view and perspective of more of where we have come from and where we're going. Put the daily and the hourly charts into some kind of context. We can see that on the inlay that the market has just come off, and it was actually just short of our high probability target for that drop-off. Gordon, do you think we're going to have any chance of actually coming down and hitting that?
Yeah, I actually, from looking at the triggers and the drivers, it says that the market wants to go up here. But if we get this shock of some reality over the next 2 to 3 weeks, the chances are very strong that it's going to move down to that lower high probability trading zone that you show in the box on the right. But I think it'll hit that and turn around and want to move up to the higher one, because I don't think we've finished this final wave up that we're working on as we put in a major long-term top. So that's what you need to be watching for here at the weekly level.
Yeah, that next target zone, once we figure out what goes on with this consolidation, the market can lift again probably up into the 1720 area, and that's where you see at the top of the inlay there.
That's what we believe the target to be right now. But, whether it drops straight down to that lower box or in fact creates a bit of a wedge in a consolidation pattern before it lifts directly up is something we'll see unfold in your daily and your hourly charts.
Yes, if we take a look at the daily chart, the first one I wanted to show is actually from last week, from July 11th. And again, if you take a look on the right-hand chart, you see a red box around an arrow, and that arrow is showing it that the trigger is the purple channel line there, the dashed purple channel. If that is crossed, then the likelihood is the market will then move to the next purple channel where it will meet some kind of resistance, whether it's just a consolidation or a reversal. I'm not sure, but that's where it's going to go if the first one is crossed. Just as a quick aside, you'll notice that my chart's divided into two because we have quite a lot going on. The left-hand side, we have Bollinger Bands, moving averages, and Fibonacci relationships. And on the right-hand side, they're all just trend lines and supports and resistances. That's to help see the charts a little more clear.
Andrew, just to put this into perspective, we talked at that weekly chart here. So once you've got that in your mind, and then you start this drill down, which you're doing to the daily and then to the hourly, and you can start to see other levels of other trading zones that it can move to. As they start to unfold, you'll know whether that trigger has actually, on a weekly basis, has been triggered, and
Yes.
that we're moving in a certain direction. So if you go back up to your weekly, you'll know where we're going, and you can get that as you work through these, what kind of trading zones we're actually hitting at lower levels. So there's a way of making this granularity work for you as you go through the charts.
Yeah, and to help orient everybody out there, if you take a look at the right-hand chart, you can see the top red line and the middle dashed line, red lines, are from the weekly, which we saw on the weekly chart, where the long wedge that the market is moving up inside. That's the red lines here on the daily chart that we're looking at. So if we take a look at this current chart, which is July 16th, again, which is the following update, which is our most recent, the red box is now around what actually occurred. And we can see that indeed the market lifted in the very first first bar, up across, through the first, channel, purple channel, resistance, and moved to the very next one. And 2 days later, it actually moved into the high probability target zone as well. But that's just an example of the arrows at the point, and I believe they're pretty powerful, knowing that if the market goes up, this is where it's going to go, or if the market goes down, this is where it's going to go. I know I get a little flack because I don't actually call it direction, but that's kind of the point, is to trade what the market actually does, regardless of what I think it's going to do, to follow the targets, the triggers to the targets.
I think that's a critical point, Andrew. You're not trying to call anything other than you know where it'll go once the market makes its decision.
Yeah, once these technicals are crossed, it's going to move to the next technical. That's just, it's not a given, but that's the high probability. That's what's going on here.
And the reason for that is because there's so much computer trading that's going on out there, and there's so many different algorithms that are used, but they are all based on some very fundamental technical tools and ideas, whether they're Gone, whether they're Elliott Wave, whether they're Fibonacci retracement. There's about 8 or 9 I would call critical foundation building blocks, and everybody uses them to varying degrees. But like a magnet, all these disparate computers eventually seem to zero in on certain levels, resistance and support in that mechanics once they start to gain momentum. And I think that's the essence of why the complete set of technical analysis that you use, and you distill it into, I know these charts look complex, but relatively simple charts, can isolate these targets, these high probability trading zone targets. Did I say that correctly, Andrew?
For sure, and that's exactly what they're high probabilities. There's no given in any of this. This is the market, and there's always random and chaos, and we never know for sure and given on anything. However, there does appear to be levels within the market that the market definitely trades to and has resistance and support from. There is, we know, for example, channels. The market moves up and down in channels. We know that the market moves up and down between Bollinger Bands. And when you start overlapping all these things together, they start to show a picture of where the market has a probability of going to. And through several different tools and techniques, that's what these high probability targets are showing, where these convergence of all these tools are saying technically the market should move to. And it doesn't always. There's, like I said, a good 80 to 90% chance that it does, but there's always a chance of failure like anything else.
I like your charting system is really unique in that the drill downs continue to use the same lines, so you have the same references. So they may seem confusing, but you can really orient yourself as you go up and down the time scales. And it's very important for those that may be newer traders or investors to really understand the differences in the time scales. Institutions deal on weekly and monthly charts. Traders will be down at the daily and the hourly charts. But the real money is often on the bigger moves, which tends to be the weekly charts, and to know which high probability trading zone it's going to likely move to.
I personally advocate using some of the smaller time frames, regardless whatever time frame you're trading on, simply to try and time your trade as best as possible.
That's your experience speaking there, Andrew.
Yeah, getting down to the 60-minute, the half, even the half hour and 15-minute time frame. Once you've got the weekly and the daily dialed in, you can dial it in even a little bit better on any given day as to what's the best time and the best place to enter given the technicals. Now we're taking a look at the hourly for the 60-minute on the S&P. A couple of quick things, as you said, Gord, they're all the same lines, all the same resistances. It's just a different perspective. You can see again the two purple channels, the one that was crossed and the one that was moved to, and then the high probability target zone that was hit. You note that there's two blue boxes, and this is just one of the analysis methods that I use. The first blue box on the left shows the very first wave of that move from the bounce, and then it's duplicated again to the right, and we can see that the next wave pretty much copies it exactly, and then extends even further out towards the high probability target zone. This next chart is from you again, Gordon, your macro drivers and macro triggers. We started including some additional charts and information to go along with our thinking of what's going to be happening. Did you want to comment on these?
Yeah, it goes back to the original points that we were talking about on the triggers and drivers. And there's so many charts that we go through all the time, but we try and highlight them here to put a little bit more meat on the skeleton. And then the top left is really looking at the statistics of how many of the S&P total on average, what the average is above the 200-day moving average. And you can see when you get 12% above that 200-day moving average, you typically get a correction. And if you run through it, you see it's pretty consistent pattern. We're there and higher now. So it says, getting into fairly, when you're trying to make a decision on which way is it going to go up or down, it says that's getting to be quite a concern. And then you look over and you say on the right, you say, but we've got a major disconnect between all of the macros that are coming out and what's happening with yield, which should force a correction. Another bit of a point. But then the point I'd made earlier, we got these conference calls that are now happening, and you can see the disconnect between the guidance which has been coming out, been being taken down, and has been consistently negative for quite a period of time, but has not been reflected in the stocks. And at some point, and it typically not at the announcement, it's in the guidance, where they start to take it down in future, and the executives are talking about the future, that the analysts over that next week or 10 days from the conference calls start to take the earnings down. So the stock may trade out at the announcement, but then you start to see things adjust. And so that's usually when you start to see it roll over. That's just putting a little meat on some of our conclusions from the drivers and the triggers. And these charts keep changing as we see the shift happening in the individual markets. So let's switch gears, Andrew, and try another one here. And let's look at gold. I know a lot of our listeners are interested in gold.
Yes, and here we have again our next plan 4. Plan 4 has the VIX and oil as well as gold. Again, you can see the macro drivers and the macro triggers for these instruments. Gord, did you want to say anything to these again for gold?
Well, I won't take more time, Andrew, on the drivers and the triggers. Our readers can look through it, but there's some really critical points that are happening that don't show up in the charts. For example, gold is now trading at its cash cost is to mine it. It's $1,104 an ounce cash cost to mine it. I mean, you're not going to mine it if it's going to cost you more to mine it than you can sell it for. So it starts to support that we must be getting towards some kind of basing level. Doesn't mean that it won't move around, a lot of volatility, but it's got to be some sort of basing level. Once you can even draw that partial conclusion, you start to have a different view of the charts. But without that, you'd start to say, oh, well, is gold going down to $900 an ounce? If it does, it would be a spike, okay, or as the games are being played. But when you start to look at the amounts of shorts and et cetera, you start to see some other things. But I won't bore anymore, but we'll get to some charts on that to help with the biasing.
The first chart starts off again, as all the plans do, with the weekly for gold. Of note here is the red circles that we see going through. We can see how the market has been following these circles quite regularly, respecting them. What's at note is the latest drop that we had moved from one to the next, and we got a consolidation. That's on the far right here, and then we have most recently dropped off again, moving towards the next Fibonacci circle, the red line that you can see there, and that coincidentally enough is around the $1,100 level, which is the cash cost that we were talking about.
Yeah, we were talking to these Fibonacci ellipses, and we do a lot of Fibonacci work, including these concentric ellipses, spirals, etc., retracements, extensions on a Fibonacci basis. So we try and simplify this chart, but with a drop that we saw, we knew was coming. When and exactly how from these circle levels. But it's suggesting, if you go to the drivers and the triggers, it says, well, we really probably got in the area of the bottom. We need to move on time to the right towards your high probability trading zone. Mm-hmm. But likely that far ellipse is where we're going to go. A little bit more time is over the next 30 to 60 days. But once we're there, we got a fairly aggressive ratchet up that would appear to be there in the technical charts. But right now the short term probably is that box over on the a little further to the right, the thing to be watching for. For those who are longer term traders, it says this is the time where you might want to be starting to consider some entry on a dollar cost averaging basis, moving in, because it can spike a little lower in the trading. Take advantage of that from a purely technical standpoint. That's what it's suggesting. From the fundamentals and the other work that we got, there's some other reasons for doing that too.
Again, I really want to point out and the technicals that are going on here with this chart, Gordon. They just fascinate me, and to anyone who's new to technical analysis, just to see what's going on here. If we start at the very drop at the top of the chart with the black dashed channel top, we see the market come down, and every time it hits at one of those red Fibonacci circles, we get a consolidation right to the point where that big drop in April conforms to this as well, because we have a large gap between the Fibonacci circles, and it does this as well. It comes down, spikes down over 2 weeks, it comes into the next Fibonacci circle where we have a consolidation. What's interesting to note as well is that we have more channel lines going on, and the next drop fell to the next level channel line that goes all the way back to when the market was lifting. It's respected that, and we are now in another consolidation between two black channel trend lines there that you can see. Again, it's respecting the technicals the chart has set up, not just the Fibonacci circles, but the other supports and resistances. That the market does this at all, to me, is just fascinating, and why I love technical analysis.
I have a slightly different view on it, Andrew, and I agree with what you're saying, but I look at, for example, an April drop on April the 12th, Friday afternoon, and through the Monday, April the 15th, when they put 400 tons of gold on the market in basically 2 hours. You can draw no other conclusion than it was a totally manipulated move in the market, especially when you look at the shorts. There's a strategy, but then it's computer driven, and it just shows you that the computers are moving to very specific targets that we, from our technical analysis, can identify, and it's a consistent pattern. Because they're truly trying to drive the momentum out of gold right now, because it's a threat to the U.S. dollar, and the U.S. dollar is a reserve and what I refer to as a currency cartel. So when you get into the macroeconomics and the geopolitics and what's happening with financial repression, it's a very clear strategy, and you can see it in the U.S. treasuries. So these moves are to take the momentum out, but you've got China buying 1,800 tons of gold, and I won't bore our listeners with what's going on, that says that physical cost, which is disconnected totally from the paper cost, has to be reconciled at some point. But they're trying to take the enthusiasm and momentum out of the market. That's why it'll take a little bit more time. Once you understand what's going on globally, the chart just show it very clearly. And then the manipulators are using the technicals to drive the market.
Well, it's definitely following the technicals. There's no doubt about that. If we go down to take a look at the gold daily level, the very first one is back on July 9th. Again, I brought an earlier chart to emphasize the arrows. If we take a look at the red box again, we can see that the market was bouncing off the lower of the two black trend channels that we were talking about earlier on the weekly time frame. It has come into the gray support zone, and then when we move forward to the July 16th, we can see that the market moved as the arrow suggested, and up to the very next support resistance, which was the next gray support zone in there, and that's where we were sitting as of that update. And then here again, we drop down to the hourly, and we can see there's a channel going on, and a break of the channel on this level is mostly the likely trigger for us to move to the next market wave, whatever that's going to be. You'll note that there's several different triggers listed on both sides of the chart, depending on what the technical is. All of these are at your discretion. There are multiple triggers, particularly for the point that anybody who's trading and whatever their risk style, they can decide which trigger is best suits them. Some of these triggers have a higher probability than others of succeeding. Mainly that those that are closer to the target have a greater probability of succeeding than those that are closer to the market. And however, the trader's personal style will have to dictate on the level of risk that they choose. And again, here is the macro drivers and macro triggers for precious metals that we included with our update. And Gordon, if you wanted to talk to those quickly.
We keep changing these charts as we see the drivers shifting around, but I mentioned the cash cost, and we have a number of charts, but here's one of them that really showing the background to that, but also the gross shorts that are out there, which says something's up, something's being prepared here, and how that amount of shorts that are being out there, whether you're going to get a short squeeze or in fact the shorts are beginning to orchestrate that final little slip down. I'll leave everybody to judge for themselves, but these charts are telling you what's underlying that current charts. What to expect or what to be a little nervous of in the short term. Sometimes you're better just to stand aside, let it play out till these particular charts finish their cycle. Maybe the shorts are off, and then to make your move. But it's balancing all of it with the technicals that I think really make it powerful here, Andrew. Great charts. I hope they're not too complicated for our first-time viewers that are looking at them. But the more you're looking at them and you work with them, suddenly clearer things become. Thank you very much for your time, Andrew. Really appreciate it. We went a little longer, but hope it was of value to our listeners. Any last comments did you like to make?
Oh, thank you very much for having me again, Gordon. Hopefully it won't be so long till the next time. Could
you tell our listeners where they could find your site and more information on triggers and your webzine?
Yeah, online at triggers.ca is our homepage where they can find us. We have a lot of different things that they may be interested in, whether it's just the monthly publication itself, the magazine, or if they're looking for some more charting services. We have several different plans that cover the S&P as well as gold and oil, and several currency crosses as well.
The drivers and the triggers that we mentioned here, and some of the charts that are showed in your daily updates, but those are typically expanded on significantly in your monthly webzine articles with as full articles or supporting charts that are with it, and that's usually 50 to 70 pages, is it not, Andrew?
Yeah, every month is it's a collection of your work for the month, Gordon. I take the tremendous amount of work that you put out, the 400 to 500 pages, and try and bring it down into 50 or 60 for the readers who just want a quick overview and skim and get the highlighted points what they can. So each month is not just another trading magazine. It's actually a full market report of what we see coming ahead in the future. And then again, depending on what their interests are, they can get more detailed charting throughout the week as well on selected instruments.
And we now have two versions of it, right, Andrew?
Yeah, there's a free public version. The public version is a distilled version, again, of our subscriber version. You can still find, though, some articles. We usually have one complete article in there, as well as the analysis for the S&P and silver, plus a collection of some other random things each month. And this is all for the free for anybody who's interested in triggers, but this is, once they get their feet wet, they can start with our free publication before they subscribe.
We'll wrap right now. Again, I appreciate the time, and we'll hopefully won't take as long to have you back again next month. Talk to you later.
Thank you very much, Gordon. Take care.
You too. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.